All right, so we'll talk about profits and inflation, like I already said. We're going to talk about what is profit, right? We will understand the relationship of profit and cost. We'll try to look up at the concept of what is profit maximization, how firms look at it, and how it may be an important concept for any industry or any business, right? From the perspective of why and how do businesses, or how or why do businesses take decisions on what cost to decide, at what margin they are going to make it, what is their break even, etc., right? So that will bring us to two things that we are going to discuss, that is profitability, production profitability, and the break even analysis. Finally, tomorrow in the concluding session, we are going to talk about inflation, we're going to talk about deflation, and we're going to look at the types of inflation. Now, let me just quickly take you through a recall on the supply curve. We've already discussed the concept of demand. We've already discussed the concept of supply. We've already seen that, like demand and price have an inverse relationship. However, supply has a direct relationship with price, right? So then this implies that when price goes up, the supply also goes up, right? Because the supplier will try to make more profit at higher prices. However, in demand, we know this was an inverse relationship. When the price goes up, the demand falls down because the consumer might not be able to afford it at a higher price, right? Now, this concept of profit, let us connect with the supply curve. I hope you all recall that supply curve is an upward moving curve. However, a demand curve is a downward falling curve, right? You might recall that we had discussed, right, that there is a point of intersection between these two curves because one of them is upward rising, that is the supply curve, and the other one is a downward falling curve, which is a demand curve, right? Now, what is a profit, right? We all know that businesses function, and one of the primary goal of any business or any production activity at large is to earn a profit, right? Now, how much profit to earn, at what rate the profit is earned, etc. This is a part of the profit analysis. However, right now our concern is that what is the basic concept around profit. So when we talk in the most basic sense, where we are not applying the market forces, where we are not applying the other factors in the market, where we are not understanding any dynamism that is coming through the environment or macroeconomic factors, we simply define profit as total revenue minus total cost. I have spent some money in making the goods and services, right? And I have sold them at a cost and earned some revenue. Now, the cost at which I have made these goods, right, will be my total cost, right? This will comprise of two costs, which will, move and understand in the further sections. And total revenue is the price at which I've sold them and I've earned some money out of it. What is my profit? When my TR is more than my TC, I get some value and that value becomes the profit. If the reverse scenario happens, that is, the TR is less than the TC, I'm not making a profit, I'm making a loss. There, I may have to reclassify, rethink, and rework upon my strategies, think about where am I going to take my business further from there, and then maybe, comprehend on issues which could be causing my profit to fall down at such a rate. Now, for any business or any firm or any, I would say, even if it is a, it's a one day old business, the primary goal of setting or starting a business or a firm is to maximize the profit, right? Now, we always say profit maximization. Has anybody by any chance heard something different, that some firm or some business saying that we are in business not to make profits but only to just give some product to the market and let people enjoy that product, or maybe we are here to minimize the losses, we are not here to make a profit. I don't think there exists a business that would ever say that, right? So we know that the primary goal is profit maximization. Now, this can be done in two ways. Now, the basic question is, I know that the business is here, or my firm is here in operation to maximize profit, but the biggest question that lies ahead is, how do I maximize this profit? Now, there are two ways through which you can maximize your profit. First way is by increasing your revenue, or second way is by reducing your cost. Because for now, for somebody like me who does not have an understanding of market dynamics at this point, I may not have any analysis of the macroeconomic factors or market forces that might be existing. To me, and to somebody who's a layman to these things, right? If I tell them that it's just two things that are important for profit, that is your revenue and your cost. So there are going to be only two ways they can think around. One is either I increase my TR, right? So my profit becomes more, or I reduce my TC. Either ways, it is going to make my profit higher, right? But uh, it is important to understand that there are costs, right? Your revenue is something you don't fix. If you recall, we discussed in the why profit has come at last. This is a very systematic setup of why profit comes in the end. Because if you recall, right, we also discussed the market. We also discussed the types of competition. We looked at monopolies. We looked at perfect competition, which is hypothetical. We looked at oligopoly, monopolistic competition, oligopolistic competition, etc. Everywhere we were talking about, price maker, price taker. Now, what were these? Right? These were actually the factors why a firm needs to determine them, because ultimately any firm in operation in business is here to make a profit. Right? Now, the basic criteria that they need to understand for setting up of prices, we know that a firm does not set its own prices. A lot of time the prices are set or determined by the market or existing forces in the market, which is both micro as well as macroeconomic combined together, right? Now, we can understand the dynamism that exists in such a setup, and we can all understand that, the impact it can have on a firm's business, right? Because when I enter business, my sole goal is that, okay, I need to achieve profitability. If not, at least in this 1 year, in the next 2 years, I'm going to be profitable business. And that will tell me whether I'm going to exist in this market or not, right? At this point, I'm not thinking about, coexisting, my dynamics. I'm not thinking about, so many other variable factors in the macroeconomics, which are very dynamic in nature. In the inflation part, we'll understand that how inflation also hampers decision making on the part of both the buyer as well as the seller, right? Now, it is important to recall what type of costs have we discussed already. Now, we know there are costs which are explicit and there are costs which are implicit. Now, if you remember, we also discussed about accounting profits and we discussed about economic profit, right? Now, logic over here is to connect that economic profit and accounting profit to understand that when a firm is trying to achieve its profitability, or when we are looking at the concept of break-even analysis, how it plays a crucial role to break these two and understand that these are two separate type of costs, or these are two separate type of accountings that we understand. Now, first is explicit cost, where we say that this is the cost that requires an expenditure, right? And fixed costs are not dependent on the level of production, right? Because they are something that a firm or a business in operation will pay because they are operating, right? And they can often be associated with the time. For the limited short run period of time, some cost becomes fixed, other cost becomes variable. Fixed is the one which does not change with the change in the level of output or production, whereas variable cost is that cost which will change with the level of production or output. That is your raw material cost. Sometimes your labor cost, when you are into contingencies, you can even see a huge impact of labor cost in your variable costs. And we know implicit costs are opportunity costs. What is the cost that I have given up, right? When I'm giving, if suppose, take for example, somebody decides that I'm going to drop off from a degree, right? I'm not going to do an MBA. I will directly start doing the job, right? Now, there are high chances that you might be having an offer in hand today on the basis of the graduation that you have. However, maybe an MBA could have offered you an opportunity to have a better package, or maybe a better organization, or maybe, culturally rich organization, anything, right? Now, that is something which you cannot account for, at least for the time being, because they are not present. But those were opportunities, right? Those were the costs which could have, incurred you some different path, which could have incurred you a different profit, which could have led you somewhere else. So implicit costs, that is the opportunity costs, are equally important for analysis to understand what we have given up to come or earn what we are doing today, right? I am sure most of you must be clear by now, because more part of this was a recall on what we have already discussed. Let us understand the concept of profit maximization. We know that profit is your total revenue minus total cost, right? I have made a product at some cost and then I've sold it at some price. Now, the price at which I've sold it, right? From that price, I'm going to deduct the cost at which I made it, and I'm going to get my profit. It could be the reverse way. When my cost is higher than my revenue, I'm making a loss, right? However, because we are only talking and trying to understand the profit concept, we are looking at a positive scenario here, okay? Now, there should be a new question to ask for all of us. Just imagine if we are all producing goods and services, if we are a firm in business, right? And we have to answer some basic questions about our business. The first is, what quantity of output would maximize my profit? The first question is this, right? So, say suppose if I say I'm into a business X. Okay, say into a stationery business, right? I make the raw material or paper and other things, stationery items. Now, a question that should come to my mind whenever I think about my business is, what quantity of output is going to maximize my profit as a producer? Then, when should I stop producing? Can I keep on producing infinitely that, okay, today I'm making 10,000 units, tomorrow I'm going to make 11,000, 12,000, 13,000? Can I increase at this rate? Can I increase it at such a fast rate? How is it going to affect my production capability? How is it going to affect my factors of production? How much load is it going to create on my overall efficiency? And then, when you have these questions intact, right, what is important is how are you going to answer these questions? Now, use the marginal analysis to answer your questions. Now, what was the marginal analysis? It is all about the next good or the next amount that you're going to spend on how much time you're going to invest, right? We know marginal talks about the next best or the very next item, very next cost, or the very next unit, or the very next time you're going to make it. So, depending upon where you are seeking an answer, are you seeking an answer in terms of money? Are you seeking an answer in terms of units? Or are you seeking an answer in terms of how long you're going to use the units as the good or the money or the time, right? Now, let us look at this table. Now, this is the profit for Jennifer and Jason's farm when the market price is $18. Okay, so the market price for their products is $18, and Jason and Jennifer are making this profit, right, at a given market price. Now, let us break. Now, there are quantity of tomatoes that they are selling, right, which we are defining in Q, and there is a total revenue, there is a total cost, and we are going to calculate the profit. Now, when they are not selling anything, right, definitely they are not making any revenue, so their TR remains zero. Let me use the pen option. Seems some issue with my pen. No, it's working. Yeah. So when I am not selling anything, definitely my revenue is going to be zero, but I have to incur some cost, right? Some fixed cost plus some variable cost, which is $14. So here I'm not making a profit, rather I'm making a loss. First, at no not selling, because maybe I've just set up my business. I have just bought the units, and maybe I've just, started to think about how am I going to take my business ahead. So at this point, I'm spending some money, definitely, which is $14, which becomes my total cost. But I'm not earning anything because so far I've not sold a single unit in the market. Okay. Now I sell say 1 kg of tomato. Okay. And the total revenue, because the price when the market price is $18. So for one unit, I'm going to make $18, right? But to have this 1 kg of tomato ready, being packed, the supply chain cost, the market cost, the cost to pay to my people who are doing the packaging and other things, comes to $30. So till this point, again, I'm making a profit of -12. That means I'm making a loss, right? Now, when I go to the second kg, now because the market price is 18, the revenue that I'll earn will be 18 multiplied by 2, and my total cost becomes 36. Now, what has happened? When I've sold 2 kgs, I have earned $36, but I've also spent $36. So technically, now this is my start point, because here my total profit remains zero, because TR is 36, TC is also 36. Now, with the third kg, I am making a total revenue of $54, right? However, my cost also goes up because obviously I'm going to spend on variable factors, though my fixed cost remains the same, which was $14. So here your $14 is your fixed cost. And with every additional units that you are selling in the market, your variable cost is increasing. So here on the third kg, your total cost becomes $44. Now the profit is 54 minus 44, that is 10. And so on. I move to the fourth, my TR becomes 72, my TC becomes 56, my profit rises to 16. At the fifth unit, my total revenue is 90, right? And my total cost is 72. Here I am making a profit of $18. Now what you have to pay attention is that this 72 and this 72. The total revenue of 72 is technically enough to cover the cost of up to 5 kgs, right? So up to 5 units is something which I can comfortably manage, and this is the profit that I'm going to make at a minimum rate if I'm working with the 5 units of quantity, right? How? Because if you check, my total revenue here was 72 and my total cost here becomes 72. Now, after this, what will happen? You will see the concept of marginal revenue creeping in, right? Now, at the sixth unit, my total revenue goes to 108, right? 108. However, my total cost is 92, so my profit goes down and becomes 16. So if you see at this unit and at this unit, this is not my maximum profit. The maximum profit that I have earned here is at the fifth unit. Anything I make above this will give me a profit, but it will be at a diminishing rate. And anything less than this that I supply will again can give me a profit, right? From here, if we look from third unit, this will give me a profit, but again, this is not my maximum profit. Neither is this my maximum profit. My maximum profit is at the fifth unit. Fifth unit quantity of the product being sold in the market gives me the maximum profit. Anything more or anything less is not the most optimum level for me to go around, right? This is known as maximization, where I'm also optimizing all my resources. Let me quickly take you to the principle of marginal analysis. Now, proceed until your marginal benefit, that is gains from producing one more item, equals the marginal cost, that is cost of producing one more item, right? Where your MC becomes equal to MB, marginal cost becomes equal to marginal benefit, you should stop here. Marginal cost becomes equal to your total revenue, and anything that you go beyond this is going to give you profit but at a diminishing rate. So don't go beyond this, stop over here. Okay. Now, finding the marginal benefit leads to looking at the marginal revenue. Now, we were looking at marginal revenue, right? What we were following through, we were following through how the revenue was going up, how the cost was also going up, but the revenue first went up at a diminishing rate, then became maximum, and then started to fall down again. Now, marginal revenue is the additional revenue that you generate by selling one more item. So if suppose you were selling 4 items, right? You were making some revenue, which is 72. And by selling the fifth item, the marginal revenue that you make is 90 minus 72. I hope I'm clear to all of you. At the sixth unit, the marginal revenue that you will make is 108 minus 90. At the seventh unit, the marginal revenue that you will make is 126 minus 108, right? And so on and on and on. Okay. Now, if you check here, your marginal revenue MR is also equal to your profit, that is 18. Marginal revenue is 90 minus 72, which is 18, and here your profit is also 18, right? So this is the maximization concept. Just understand it as a very simple concept. Do not think about I told you at this point, we are keeping what constant, that market forces are constant, right? And this is a condition where we know most of the factors are under our control. right? So just to bring a basic understanding, we always keep the factors as at some level we are keeping them stable. However, when you will go into real calculations, you will see it is not as simple as this, right? Because market is not static. First thing, market is dynamic. Second, the market factors are something, that are not under anybody's control. Even the market cannot control itself. Sometimes we say that market is a self-regulatory mechanism, but you will see that that self-regulation also brings about a lot of crests and troughs, right? You will see a lot of rises and falls within those regions also. So that is why, for basic understanding, never apply this like this. This will not be applicable simply like this, because here we are keeping all other factors as constant. But in market, in reality, other factors do not remain constant, right? So I have told you marginal revenue is the total revenue divided by the quantity. Now, marginal revenue is something that can be graphed, right, through a marginal cost and a marginal revenue curve. Now, let us look at the marginal cost and marginal revenue curve. On the x-axis, we are taking the quantity of the product, that is tomatoes, and on the y-axis, we are taking the price. Okay. Now, understand there is a market price which has been set at $18, which I told you, right? The market price could be set because the market here could be a competitive market, and the firm is a price taker. It is not a price maker. So whatever prices is set by the market becomes the price that the firm is going to sell their product in. So if $18 is the price set by the market, this is the price at which even your firm is going to sell the product. Okay. Now, we know that with every sale, right, we are trying to quote our marginal cost and the marginal revenue. Now, we know the optimal level is 18. So let us draw a line at 18. That's what we have done over here, right? We've drawn a line at the fifth unit where it intersects, right? This is the most optimal point of your sale. If you sell below this, you will still earn a profit at third and fourth unit. If you sell more, definitely again you are earning a profit. But if you talk about the maximized profit level, it is at 5. At both below and above, you are earning profits, but they are not your most optimum profits, right? For earning those profits, either you are spending more money at sixth and seventh unit, or you are still not able to make up to the best market prices at third and fourth unit. This is how we look at it. Okay, we don't say that don't do a business unless you are not making 5 and 5K but stop selling. No, this will not be the criteria. The criteria is to understand that at an optimal point, we know that below this and above this, what we are making are our profits, but they are not the most optimal profits, right? So if you keep constantly selling at an optimal rate, you are having a most optimal efficiency, right? But in reality, again, that does not exist because we are keeping so many static factors, and market doesn't work with such static factors. There are dynamic factors, there are rapid changes, there are so many factors that contribute to change your market forces, and that is why this we need to be mindful of this. Okay. Now, short run costs for Jennifer and Jason's farm, right? Now we have seen, we know a market price. Now let us break into the short run cost, because in the long run, all your factors can become a variable factor. However, in the short run, we have some factors which are fixed and some other factors which are variable in nature. And if we keep that in mind, we will be able to comprehend a picture, right, of what my business would look like maybe 2 years or 3 years, that I'm seeing, as the minimum short run, and the advent or the start of the long run for my business. Okay. Now let us quote again the quantity of tomatoes, the total cost, that is TC, the marginal cost of each unit, the marginal revenue of each unit, and let us understand the net gain, right, through MR minus MC. Now, when 0 units were being made, the total cost was $14, right? The marginal cost at the next first kg is 30. So the differential value, that is $16, is your marginal cost. Here your marginal revenue is $18. So technically, if we go by the profit of margins calculation, you have started to make profit by selling the first unit itself. right? For the second unit, the cost became 36, right? And the differential in the cost is 36 minus 30, which is 6. You have sold it at 18, so you've earned a profit of 12, 18 minus 6, and so on. Now, again, how are we going to define what is my most optimum output when I'm trying to understand through marginal concept? In the previous table, we understood with the total revenue concept. Here we are understanding with the marginal revenue and marginal cost concept. Now, if you pay attention to the last table, right, here by the third unit, your profit is 10. By the fourth unit, it has come down to 6. By the fifth unit, it has become 2. But till this fifth unit, it is still positive. The moment you move to the sixth unit, it becomes negative, that is minus 2. So what is happening? Technically, you are still making a profit, but you are spending money to make that profit, right? And by spending that money, if we go by the concept of making the sixth unit and spending on the sixth unit, your spending on the sixth unit is higher than the uh, cost you are earning, particularly on that sixth unit, right? For example, up till 5 units, whatever was happening was a profitable situation. But if I just calculate that by my sixth unit, what will happen? By my sixth unit, my marginal revenue has come down, right? But the marginal cost has remained the same. Now, when my marginal revenue has come down and I see the differential value, technically what is happening is I am spending more money to earn that small profit. So technically, my money spent on sixth unit is higher than my money earned on the sixth unit. This is how we define it, right? So I'm spending more money to earn this profit. Now, I have a question. Does that mean I should not make it? I should not sell it? If somebody comes and tells me he wants 7 kgs of tomatoes, I will say, no, I will not give you. I will give you only 5 because that is my profit maximization. Do we mean this by that? Definitely not, right? This is to aid you in your decision making to understand that with every increasing unit, you are spending money, and maybe you should understand where or what are the places where you can cut down on this revenue that you are spending to make additional profits on your products and services, right? Because if we go by this logic, after 50 unit, I should technically stop selling. I should say, no, 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 I will not sell. I have already made optimum profit. If you will buy more, my optimum profit level will come down. I don't want that to happen, right? So understand, economics is to aid somewhere in a decision making and not to be the decision itself. I told you this in the cost also, right? In the price also, that there are methods, there are mechanisms, but they are not the end means. They are there to be connected to other concepts and aid your decision making. That is exactly what we are learning, right? We are looking at the managerial aspect of it. Now, when is the production profitable? Now, this depends on the economic accounting and taking into account the opportunity cost. Now, economic profit versus accounting profit is something that will take into consideration just your implicit cost, just your explicit cost, or both implicit and explicit cost, right? Now, when we say there is a normal profit, technically it could also mean that your economic profit is zero, right? Because here the amount that you spend is the same amount that you have earned, right? And normal profit is when a firm could do no better using their current inputs, which is actually a good thing, right? So I know for myself that even if I am making normal profits, right, I am doing my best to reduce the cost to the maximum. But if I try to reduce cost more, it could even mean I may have to compromise on my quality, I may have to compromise on my service. And sometimes businesses will not take that decision. They will be okay earning normal profits, because if they aim for supernormal or abnormal profits, it could in the long run mean that they're going to compromise something. And compromise in business means that you're putting your business in danger, right? It could lose to competitors. It could lose because consumer no longer associates your products as quality products. Consumer no longer sees your brand as a quality brand, and a number of factors. Maybe you're cutting down on advertising, you're cutting down on sales, which is actually getting your total revenue to fall further, right? So understand, normal profit is that domain already, where a firm can do no better than what they are currently doing, and that's a good condition, right? That is not something that you should be worried about, or you should be overthinking about. Okay. Now, with all these concepts that we have covered so far, keep one thing in mind. We have still not talked about macroeconomics. We have still not talked about the role of other domains in economic decision making. But whatever understanding we have gained so far in economics, just keep it intact and understand and discuss this for yourself. If you're starting an organic farm in Punjab today, what do you purchase or pay for to make your farm as cost efficient as possible? Now, what you need to think from is the perspective of fixed and variable costs. Okay, I will keep here to discuss for today, that is the break-even analysis. I hope you have that question in mind, and I hope you have thought about it, and I hope you can recall the concepts that can connect you to understand that if today you are starting your farm business, okay, forget Punjab, even in the city in which you are in today, if you plan to start your farm business there, what are some of the basic criteria from the economic perspective, only and only pure economic perspective, no marketing, no macroeconomic concepts, no dynamic markets, competitors, etc. These are later things, just the basic economic concepts that you will keep in mind. And please understand, managerial economics will help you in aiding your decision. They will not directly make decisions for you. It is not possible, right? No one concept, no one definition, or no one subject can help you make a decision. It is a comprehension of your understanding. It is a comprehension of the factors of different subjects or different domains that you connect together to take a decision. So if today I've told you about profit, you can just simply say, "Acha, okay, this is economic profit, this is accounting profit. I have understood. Now I will start business and I will look at this concept to make profits." Don't do that. You're going to fail miserably. Okay, this is from the economic perspective. Please take into account any market perspective, the competitors' perspective, the price setup concepts, the dynamic factors, your PESEL. PESEL is the political, social, legal, technological, and other environmental factors around you. And once you have a research, right, then only go ahead with your price setting, cost setting, break even, profits, margins, etc. Right? Because I am sure somebody might say, okay, so if it is so simple, can I start my business now? You definitely can start your business, but just on the basis of this, don't make your decisions, right? This will help you comprehend and break down some of your answers that you are trying to seek for or understand in a longer run or in the broader scenario. But this is definitely not just the only answer itself. I've been emphasizing this point over and over again because I realized with some of your questions that maybe you are thinking it that this will answer your questions around a lot of things. This will not, right? And in the managerial perspective, it is important that you connect these concepts well to all the other dynamic concepts that exist in the market. Okay. Now, it is very important before you start to understand break even, just let us break some key terms that will help us in broadening our learning on break even analysis. Okay. Now, break even is the point at which the total revenue will be equal to the total cost, right? And break even analysis will help businesses make decisions about prices, cost, and the level of sales. Now, again, like I said, does that mean that if I'm making my if I'm meeting my break even at fifth unit, I should not sell more or I should not make more? No, that is not we are trying to say here. We're just trying to say that this is the minimum, right? Or this is the most optimal, right? Is this the end? No, it is not the end, right? If somebody has started, up to what level they should go, this is the minimum level they should go at. And this will guide you further into how do you work on reducing those costs, the marginal costs, so that you try to balance the profits in a better manner. Okay. Now, turnover or the sales revenue. It is a money where the business receives from selling the goods, right? So obviously when businesses sell something, they receive money from it, and this is known as your sales revenue or turnover. Now, total revenue is the price per product multiplied by the quantity sold, right? We've already covered the concept of price. There, I remember one of you asked me that, can we set prices like that? No. Again, the prices are not set like that. They are only strategies that can help you in making decisions. They are not the decisions in themselves, okay? So total revenue is the price per product multiplied by the quantity sold. So just imagine if I'm selling tomatoes, the price is 18 rupees per kg and I'm selling 5 kg. So my total revenue is 18 multiplied by 5. So if I charged euro 20 for each product and sold 10, then my total revenue would be 20 multiplied by 10, which is 200 euros. Now, what is another point that we need to understand is the contribution. What is the contribution per unit? Now, contribution per unit over here is the selling price per unit, right? If you want, you can write it down, right? Contribution is equal to selling price per unit minus the variable price per unit. That means, how will somebody ask you as a question based on this? The question that I can ask you is that, okay, so suppose you are Jason who owns the farm. So I ask you, Jason, can you tell me, you know, what is your most optimal contribution unit? So my most optimal contribution unit is where my selling price per unit and my variable price per unit match. Anything less or anything more is either the situation of profit or the situation of loss, right? And margin of safety is the point at which the firm's actual sales are greater than the break-even point. So if my break-even point is at fifth unit, margin of safety is up to that actual point where my sales are higher than my break-even point sales, right? And that will help you answer the question on how, to what extent, or up till what optimal extension can I take my business, and how much should I keep on producing. So somebody can produce as much as they want to produce, right? Produce as much as, because anyway, if it's a farm product, you will want high production, right? Because there will be higher chances of being a perishable product in nature, there will be higher chances of it's getting rotten, etc. That's why I said that here, for now, understand that we are keeping all other factors as constant. One factor I've told you myself, which is, perishability. So I know my product is a farm product, it is perishable in nature, it will not last for a very long period of time. It has a fixed shelf life. And that shelf life is very, I would say, the shelf life is very limited. It's not an unlimited shelf life. Even with the best supply chain, that is the best cold chain that is possible for me to arrange, I may not be able to keep it for long, because that means the longer I keep it, the more cost I'm going to incur in it, right? Which is logically not advisable for businesses. Now, Andy set up AP Sports in 2012, and his costs and revenues are as follows. The price per unit is 10 euros and the variable cost per unit is 5 euros. His fixed cost is 10 euros. Now let us lay down a table to understand the theory. Okay, now the number sold is here 0 to 5. The fixed cost, the variable cost, and the total costs are there, and then we understand the total revenue. Now at 0 units, we know that even if he's selling 0 unit, he has to pay the minimum fixed cost, which is 10 euros. Because he has not done anything, his variable cost is 0. And because he has, not incurred any cost on variables, his total cost is FC plus VC, which is 10. So 10 plus 0 is 10. Now, because he has not sold anything, definitely his total revenue is also 0 here. In the first unit, his fixed cost is again 10. There is a variable cost per unit, which we defined here as 5. So we will take this value as 5. Now his total cost becomes 15 euros. And the price per unit is 10. So he is selling it at 10. So his total revenue is 10. His total cost is 15. Again, till here, he is not earning any profit. In the first scenario, he's making a loss of 10 euros. In the second scenario, he's making a loss of 5 euros. Now, in the second unit that he sold, he had a fixed cost of 10, variable cost of 5 multiplied by 2, which is again 10, and total cost of 2 multiplied by 10, which is again 20. So, your total revenue is 20, and your total cost is also 10 plus 10, which is 20. So here, TR minus TC is equal to 0, right? At unit number 2, your TR minus TC is equal to 0, which technically means your TR is equal to your TC, right? Now, in the third unit, again, he is going to pay a fixed cost of 10 euros. The variable cost will be 5 multiplied by 3, which is 15. The total cost is going to be 10 plus 15, which is 25. And because price per unit is 10, he's going to sell it at 10 multiplied by 3, which is 30. Now here, for the first time, his TR has exceeded his TC by 5, right? 30 minus 25, which is 5. At the fourth unit, this will become 10 as your fixed cost, 5 multiplied by 4, which is 20 as your variable cost, and 4 multiplied by 10, right? Which will be your total revenue. So your total cost will be 10 plus 20, 30, and your total revenue is 40, right? Again, here the profit is plus 10, 40 minus 30. By the fifth unit, the cost has, what has the cost gone up? Sorry, the fixed cost remains 10, the variable cost has gone up and become 25. The total cost becomes 25 plus 10, which is 35. Your total revenue that you earn is 5 multiplied by 10 euros, which is 50 euros. So 50 minus 35 is the profit that you have made over here, which is 50, right? So over the period of time, with every additional unit, definitely his revenue is increasing, right? Initially, it did not increase, then it became equal to the total cost, and anything beyond this means that you are going to make a profit, because this is the point where you have achieved your break even, right? And when you go beyond this point, you are going to make a profit, right? So this is how we look at it from the perspective of breaking into break-even analysis. Now the fixed cost, what is here to understand is your fixed cost is remaining constant because we are taking short-run scenario, right? This is a short-run scenario. That's why your fixed cost remains constant. Sorry. The total costs are when fixed costs are added to the variable cost, and the break-even point is at 2 units where the TR is equal to TC, right? I told you the point where your TR equals your TC is known as the point of break-even. Now, this is one way that you make a table and you calculate it, right? Somebody might say, what if this table goes wrong? What if I make an error? Or what if I want to check the way I calculated, is it correct or not? So there is a formula method. There is a much quicker way to calculate the break even, which is given as total fixed cost divided by the contribution per unit, right? I told you in the beginning itself, keep in mind the concept of contribution, because what is an every additional unit adding to my overall profits or to my overall, prices is important for me to understand, because if it's not adding much or if it's not doing any value addition in terms of being able to overtake the cost, I should rethink, I should reevaluate, and then maybe I should take a deep dive. Right? Now, why is break even useful? Somebody might say, why do I ever need to understand break even? Is it not obvious that as I will move and I will achieve one point where my revenue will become equal to cost, and anything above it will definitely mean that I'm going to make a profit? No. First thing is that in case of any price changes, if you have a break even concept in mind, as soon as there are price changes, it will help you assess the impact on your overall revenue. Then it will also help you assess any change in cost. What if the variable cost goes up because raw material becomes costlier? What if the labor wages go up, right? And the labor start charging more money, so on. Definitely, it is going to be a planning tool, because if you have to take a decision that when I move from my short run to the long run, when all my inputs are going to become variable, at what optimum level should I think or should I plan for? And it is an essential part of any business plan. If even if somebody plans to sell their business, or even if somebody plans to, just expand their business, where should I stop and where should I move to my next product line? Where should I do the switching? Do I require to do a switching? Is there a scope to do a switching? All these questions will be answered from the break even concept. Okay, if you know this concept of break even, you will be able to take broader decisions around this. But again, be very mindful. These are some concepts that can help, or these are some concepts that can assist, but these are not the only concepts that you use to make your decisions. They are to aid your understanding, not to confuse you further. Okay. Now, there are obviously there is if there is a concept, there has to be a problem around that concept. The same implies to break even, right? The basic problem here is it is only a forecast, right? Like I told you, this will aid your decision making. This is not the decision in itself. It can tell you a lot of things. It can help you picturize a lot of things. It can help you understand a scenario, but it's not the answer in itself, right? Because break even is only a forecast and it is bound to change under dynamic factors. Now, dynamic factors are the price of raw material. For example, we know that there could be multiple reasons. If the crude oil prices go up, the price of transportation goes up. If the price of transportation goes up, my supplier will increase the cost on the raw material and I have to pay him more money. Now, I was thinking I will achieve break even at 5, but just understand, you why you are not able to achieve it at 5 today, because of a dynamic factor change, which is the price of raw material. Then just understand the number of competitors suddenly increase. Say a change in the political setup of the country, which allows more domestic player to enter the market more freely, will increase your competition. The moment the competition will increase, the prices will change. And as soon as the prices will change, your total revenue can change. Because initially, maybe you were earning some X revenue at some cost, right? But now the cost remains the same, but price falls down because there are more competitors in the market. And as a result of this, your total revenue value can come down. Always know that the current market is volatile, very volatile, right? It's not that today I've just told you this concept, maybe by the time you apply it, most of the factors will change. Then you will say, what is the use? You taught us this, but this did not happen. It can never happen because you are working in a volatile environment. You're working with dynamic factors. You are working with, some factors which are driven by multiple analysis, not a single analysis. And the break even becomes less predictable over here, right? Now, I predicted a value of 7 as my optimal value, but I realized that 7 is not even an achievable number because it doesn't fit into the criteria that I was counting it into, right? So here, what happens is my break even has become a useless concept here. What is the use of this concept now that I was working on something, but the value that I got, and when I compared it to what the existing value in the market is, it is not matching anywhere. So here, is break even even analysis useful? Yes, it is useful. Is it 100% applicable? No. Is it 100% accurate? No. And is it by any chance, the only criteria that you will use for making your decision? Definitely not. Right? So I hope this answers your questions around break even as well, that, how, what, and when to use it.